we're not able to broadcast into Facebook, so we're just gonna do it live. We're going on for the Not Your Average Investor Show Thursday edition. I'm your host, Pablo Gonzalez. My co-host, his initials are GC. It stands for Great Co-Host, and Gregg Cohen. Welcome, Gregg Cohen.
What do you know? That was incredible, brother. Good to be here with you. Fired up to be with all of you here for the property of the week.
Week. Right? Like if we're That's right. Today is the Thursday edition, which is the JWB property of the week.
Week.
There you go. There it is. And we're doing something a little bit different and the same old as well, right? So the same old is what I'm going to tell you, that this is an interactive show. It's driven by you. We want you asking questions, putting them in the Q&A, talking to us in the chat. Little minutia. If you pop open that chat, it's defaulted to right above the text box. It just says all panelists. And that's only speaking to Gregg and I if you chat something in there. If you drop that down and put it as all panelists and attendees, now you're talking to everybody. You're talking to John, you're talking to Lee, you're talking to Mike Foster, talking to Aaron O'Neill, you're talking to John Evans, Margaret Smith, Rob Jones, Sergio. Good to see everybody. Ken. Who else we got? J.A., Ernest, Gunraj, and Arthur Haber. I hope I'm pronouncing that correctly. So I encourage you all to chat in there, drop that down so everybody else can see it. That way, if you have a good question that somebody else can answer, it happens, and maybe you make a new friend. And if you want the questions to be asked on the show live, do like John Aklagi just did. Pop open that Q&A box and put it in there. The truth is that I monitor all of it, and I'm going to try to get it all on the show, but there's a lot going on. I'm trying to focus on what Gregg's saying because he quizzes me every once in a while. So if you don't want me to go cross-eyed or look stupid when you ask me a question, maybe you do want that. Who knows? But put that in the Q&A. Put that in the Q&A box. And last but not least, if you love what you're hearing, you want to have more of a serious breakdown of what rental properties are all about, how to pick the right market, what to look for, what the right markets are, what the top rules of it are, and what JWB does better than everybody else, and get the free investor toolkit, which is what we're going to be tinkering with today. Go to jwbwebclass.com, spend some quality time with my boy Gregg Cohen as we sunset this webinar, right? We're about to do a new one. So you want to hurry up, and this thing's going to be a classic, right? Mm-hmm. You're going to watch it at its peak. So go check that thing out. And last but not least, I said we're doing something a little bit different. We've realized that people really love this show. They love the Thursday edition. They love the property breakdown. So we're going to start repurposing it into a podcast. So don't be surprised if I kind of over-explain what we're looking at on the screen and what I'm doing when I'm messing around with the financial model, just so that for you who's listening right now in the future, listening to the podcast, this one's for you, buddy. So be patient with us, for all of us here live on the call. And without further ado, Gregory Cohen. Gregg, what's your middle name, man?
My middle name is Michael, which is M. So if you said that GC stood for great co-host, what does the M stand for?
Great master co-host. I don't know, man. You're going to have to give me some time right there. But without further ado, let's pull up the JWB.
Pablo, are you messing with us? Are you messing with us, man? You're a little frozen. You're a little frozen there. You messing with us?
I spoke too soon, Am I back? Do you see me?
Yeah, you're back.
Zoom literally just booted me off, right? So kind of counted the old chickens before they hatch. But we're going to go right back into it, right? So we are popping up the investor toolkit sample, which is this spreadsheet that shows a typical JWB property. If you go to jwbwebclass.com, you get 3 of these, right, Gregg?
Mm-hmm, you do.
You get 3 of these to compare from. And right now we are looking at 7903 New Kings Road, which is way better than the old Kings Road, obviously, in Jacksonville, Florida, zip code 32219. It is a 4-bedroom, 2-bathroom house with a carport. Purchase price $130,000. Estimated rent range $950 to $1,000, and it is showing it is a single family home, single story. Looks like a cinder block exterior with a low sloped roof, and an estimated conventional financing total rate of return of 10.21%. Now, Greg, I see a couple of things here that are a little bit different. And you can stop me here if I'm wrong, but $130,000, this is way lower than any other house that we have reviewed on the show so far. Can you, but I also see the rent price, you know, the rent is a little bit lower as well, right? Like usually your rents are in the $1,200 to $1,400 range. But the rate of return is right in line with what we've been doing, right? That like mid 10% of the last month or so since the interest rates dropped. Where am I wrong? Am I right? What's going on here?
Well, there's a lot to unpack from what you just said there. Let's first focus on this purchase price. Pablo, how many folks have we had reaching out to us, either questions on the show or comments in the group, or how many walk and talks have I done about how you can be able to buy properties needing less than $40,000, or helping people figure out ways to raise that $40,000 to be able to buy a turnkey rental property? How many times? Let me count the ways, right? Like more than the fingers that I have, right?
It's often. It's a prevalent question that gets asked. So I'm glad we're doing this.
So the first and most noticeable thing is what Pablo said first. Purchase price of $130,000. That's not normal, right? I was a little bit skittish about this because I don't want to set the expectation with everybody out there that it's normal to have a purchase price of $130,000. It's really, really rare. But for those clients out there who are a little bit cash strapped, you're close, but you're a little bit cash strapped, this is an opportunity that you don't see very often, right? If we go to that conventional financing tab, don't even go there. I can just do the math, right? So you've got basically 20 to 25% down here. Let's see, 20% of 130,000 is 26,000.
Yeah, I was doing the math a little while earlier. It's about 32,000 to 35,000, right? It's less than that usual 40,000 that we talk about, right?
It's even a little bit less because I think what you're calculating is 25% down.
Correct.
Right. So, you know, you're probably able to get in here somewhere around 30 to maybe 30 to 35, really, for a down payment here. So we talk a lot about strategies to be able to help you raise capital. Well, here's the coolest strategy for you to be able to buy if you have a limited budget. The purchase price is lower, which is obviously really, really fantastic out there. The first thing that jumped out to us is the purchase price, but the most important thing is the return on investment. So 10.21%, near the highest that we get. Again, we're between 9 to 11% is what you're going to find from JWB. So anytime we're over 10%, that's near the higher side. And of course, that's the type of property that I'm going to bring to you guys as the recommendation that I would give for you to purchase this one. Or of course, if you're not in a position to purchase, this should be a trial run for you. You should go into this assuming that you're asking the questions you would ask if it was the right time. And that's, of course, why Pablo and I are here today.
That makes perfect sense. So, Greg, one thing I want to throw out there, right, that Lee kind of called out that I haven't called out here in the chat is this is not a new construction property, right? JWB does new construction. They do remodel properties, and we tend to see lower prices with the remodel properties, right?
Yeah, absolutely. You're not going to see a brand new construction home anywhere around 130,000, right? Your typical price points for new construction are really around 180 to call it 210,000, maybe a little bit lower if it's a townhome, brand new construction, but you're a far way away from 130,000. So your renos, generally speaking, are kind of that 150 to maybe 180 type of a range. So this is even low for a reno, and you're just not going to see any brand new construction anywhere close to this.
Okay, great. And again, for those of us that are, John, I see your questions. We're going to get to those. We're going to do a little property breakdown. You know what? We can get to John's first question right now. He asks, Are these properties, John Aklagi asks, are these properties that JWB has already bought and currently renting out?
Yes, absolutely. So these, and one of the best things about this property, another reason why I'm choosing it to recommend for all of you for this week, is because it is already rented. It has a resident in place through 2022. So 2 years of a lease. And that means that it's cash flow positive from day one. You know, that's probably a good time to talk about that, because I say that a lot. Hey, you're going to be able to buy this property from JWB. It's cash flow positive from day one, cash flow positive from day one. That's not normal when you're buying rental properties, right? If you're going at it alone, it's not normal. That's not normal if you're buying it from another turnkey rental property, which is a company like JWB who packages this all up to you and serves it on a silver platter. And I know, Pablo, this is probably a good time for us to kind of revisit that chat, because I think your eyes were opened a little bit when I kind of explained what the real world is like there, right?
Yeah. I mean, when you said it's not normal for this, you said it's not normal for this market. And I was like, wait, for this market or for this business model? And you said, yes.
As I do often when you ask me a really tough question with two answers, I say yes.
That's right.
Yes is the right answer. It's not normal for this point in time. Is not normal, like the market today. It's not normal for this. And I can explain that a little bit more, but it's definitely not normal for this industry, which is a little bit more of a kind of a long-term view of this, right? The normal way, and many of you will kind of understand and kind of feel what I'm talking about, as far as maybe you've tried to buy rental properties yourself and it was a challenge, right? Well, if we're just thinking about the timeline to positive cash flow, it is really long if you're going at this by yourself. You know, for anybody who is out there who has tried to find a rental property and gone down the normal route, what you do is you typically work with a real estate agent, and that real estate agent brings you properties. Many times you go and you view it with them, and you spend a whole lot of time. Well, first of all, you spend time interviewing the real estate agent. Then you spend a whole lot of time going out there and looking at it with them. And then you spend a whole lot of time getting properties sent to you that may be the ones that you're interested in. Many times this is just an auto email that's sent to you though. So it's like, then you got to spend the time to like analyze every single one of them. Then you got to spend the time to go and talk to the real estate agent and say, yeah, this is something I'm interested in. Then you got to spend the time to figure out what your offer is, you know, based on what the rent's going to be, how much repairs does it need. You got to spend all this time. And then what you do is you spend probably 6 months to 9 months sending in offers to be able to purchase. And you know what happens during those 6 to 9 months? You get rejected a lot, right? And this is an emotional thing sometimes for folks, especially with your first rental property. Like the first time you put an offer in, you are so fired up about it. Like you are ready to go. And then the 15th time when it's rejected and it's outbid and it went to a multiple bidding situation, you're pretty flabbergasted. Like you're worn out by it. And that's 6 to 9 months of what the real world is like to buy a property. So let's say that you get past that. Then what's the next step, Pablo?
The next step is you get your offer accepted, and now you need to do some property improvements, right?
Yeah, I mean, we skipped through a few there, right? Like you got to get the loan, you got to actually figure out your title, your insurance, all. We're going to package that up and say that that's easy, which it's not. But the next step is what you're talking about. Is now you got to manage a contractor to do some repairs to get the property into great rental shape most of the time, right? Do contractors have a history of going over timeline and over budget, Pablo?
As a recovering contractor, I would say yes. If they tell you 1 month, it's 8 months.
Yeah, exactly. So again, we're talking about this timeline to positive cash flow, right? Your timeline is 6 to 9 months until you close on the property. If it's supposed to take a month to do the renovations, it's 2 months, right? So now call it 8 to 11 months timeline to positive cash flow, right? Then maybe you were prepared and you started to interview your property manager while you own the property and all that, and you got them on board, but maybe not, right? Maybe then you have to go and interview your property manager. Once you've got this asset that can then be rented out, best case scenario, they might rent it out in 30 days, more likely probably somewhere around 60 days. So now there's another 2 months. So we've just talked about how your timeline to positive cash flow here. Oh, and then once they rent it out, then it takes, 15 to 30 days for that resident to move in. So tack on another month of that, right? Your timeline to positive cash flow is a year. Really, best case scenario when you're going at this kind of the normal route. When you work with a turnkey provider, they're going to cut that timeline down significantly. And for you, if you're somebody who's trying to get your money out of the stock market, trying to diversify, you realize today you got to diversify. You don't want to diversify in a year, right? The ability to do that today is incredible. Like, for example, we know what happened with COVID, and we know how the market tanked, right? If you decided January 1st that you wanted to go out and buy rental properties, and you did it the old-fashioned way, and you were in that process of putting in offers and COVID hit, that means that your money was still in the stock market. And it would have taken a 30% haircut, you know, in the span of a couple of weeks. Since then it has recovered, but the volatility really, really hurts you there. So, you know, you can come to a turnkey rental property company, and basically what they do is they cut a significant amount of that timeline out to positive cash flow, or almost all of that timeline out, depending on the quality of the turnkey provider you're working with.
Yes. Let me pause here then and just kind of reframe it from the uneducated person's eyes of mine. So you've just described the traditional, I want to invest in rental properties and I'm going to do it all myself, right? That is the whole, like, get a loan, do, you know, like put out 1 million offers, get a loan, secure it, find a contractor, find a property manager, find a tenant, right? Like a turnkey rental income property provider handles all that stuff. And it's in the business model, it's going to be one call, right? Because that's what it means to be turnkey. Now, the difference between JWB and other rental, you know, turnkey rental income providers is not just that you're one call, but day one, this thing is positively cash flowing, right? When you say cut that time down, you eliminate that time.
We do. So for JWB, for the client that purchases this property, anybody on the call, if they were interested in it and they reached out to my team, they can put this under contract and close on it in a very short amount of time. And it's already been professionally renovated. There's already a resident in place. You close on it, you're earning positive cash flow day one. But let's kind of talk about what the difference is in this market. You know how I was talking about like the industry? I kind of showed the difference and the timeline to cash flow for the industry. Let me tell you about the market right now and why not all turnkey providers are created equal when it comes to timeline to positive cash flow. So JWB has these assets that have already been renovated and we have residents in place with long-term leases. You go to other providers out there and they don't have the inventory available. So they get creative. And what they do is they're still accepting new clients on board, and they put a fancy looking spreadsheet, something like this, in front of you, and they say, this is what this house is going to perform. But guess what? They haven't even purchased that house yet. I'm going to say that again. A lot of turnkey providers are in such an inventory crunch right now. The houses that they sell on paper, they haven't even purchased yet. They have them under contract. And then they, of course, are going to sell you on that property, but they haven't even closed yet. And I got to tell you, there's a million things that can go wrong from contract to closing for a turnkey company that can really hurt the end buyer, right? Imagine if you bought the property, right? You signed up for the property. It was just under contract to purchase from that turnkey provider. And then something went wrong and they couldn't actually close on it, right? Maybe the seller got cold feet, or maybe there was a problem with the title or something, right? This can have a huge impact to your experience because now you're starting over again with that turnkey provider. So that's really the state of a lot of these turnkey providers. But let's assume.
Well, let me stop you real quick.
Okay.
By starting over, you mean money is still in the stock market where something can happen. You're still on like a pause pattern as opposed to just like moving forward with something that you decided, and that has some psychological and then some actual financial impacts if, like, let's say the market tanks during that spread, right? Yeah.
If your money's still in the stock market, and then the stock market would tank because you had to then decide on a new property with that turnkey provider because the turnkey provider did not really own that previous asset that they were selling to you.
Okay.
And that happens a lot, unfortunately.
Okay. Yeah.
Doesn't happen with JWB. We are so farther along in the process. We own the house. We renovated the property. We filled it with a resident. That's not normal. But we have inventory, right? We thought about this years and years in advance. And this is a wonderful thing for clients, of course, because they get cash flow day one and their experience is a lot better.
Yeah. So when you say you have inventory in the past, we've spoken that you buy enough land to know that you're going to have enough ramp of building new things to suit so that if you don't have enough renovated properties, you can release that. But this one's different, right?
Yeah. Well, this one's different. So let's talk about why why we can do this, and the fact many of you have heard about how we have stockpiled land and stockpiled renovated homes for our clients to make sure that we don't have to take those types of shortcuts, right? It's not a good thing for a provider to be without inventory. Any business out there, if you have a whole bunch of people that want to buy from you, which most turnkey companies do right now, it's a really popular type of investment. You don't want to be there without inventory. So they get creative and they come up with these strategies to put it under contract. They haven't closed on it yet, and then they sell it, right? But here's another thing. Let's just say that they actually close on it. Assuming that they close on it, there's still a timeline where they need to renovate the property for you. And so for you as the buyer, you put a down payment down with them, but you still have to wait. Timeline to cash flow is still long, right? You still have to wait. It might take 3 months to renovate the home, right? If it's a brand new construction home, these other turnkey companies, they sell them pre-construction now because they don't have the inventory. So that best case scenario is taking like 6 months to build a home, to 9 months really, depending on the builder, okay, right? And then they need to rent the house out and all this. So when I was kind of talking about industry-wide, it's a difference of a year, just kind of a normal if you're kind of going at it alone versus a turnkey company. But there's really a separation between turnkey companies that are prepared for the shortage of inventory and the ones that aren't. And what you'll find if you go to some of those ones that aren't prepared, you'll hear things like, hey, I'm going to put you on a waiting list, or yes, we have inventory. It's pre-construction that we're selling, or it is pre-renovation that we're selling. And in your mind, what you should think is timeline to positive cash flow is 6 to 12 months still. And that's really hurting investors out there. Not the case, of course, with JWB.
I get it. And at that point, and I want to preface this by saying we have 3 really good questions in the chat and the Q&A that I'm going to get to, but I want to clarify this, hit another point real quick of what this property, what you're doing with, and then we're going to get to these questions. Yeah. Just to put a button on it. In the scenario you just described, now it's no longer, if you put the down payment down, you give it, you're under contract with the turnkey provider, that still might take 4 to 6 months. Now it's not that your money might be in another volatile place as much as you're losing 6 months of ROI that you could have had, right? Like now your money's just not doing anything and it's in limbo as opposed to making you money somewhere else, right?
Yeah, exactly. Right. We talked a lot about the opportunity cost that comes along with investing in something different versus investing in rental properties, right? If I compare it to the stock market, right, you typically don't get monthly dividends or not high monthly dividends in the stock market, right? In rental properties, one of the most amazing things and one of the reasons people come to rental properties is because of that consistent, call it dividend income, which is your gross monthly cash flow coming in every single month, right? So what you're referencing, Pablo, is, if it takes 3 to 6 months to renovate a house or 6 to 9 months to build a house, and then 1 to 3 months to fill a resident with it, your opportunity cost is great if you work with a provider who doesn't have this buttoned up for you, right? And at the end of the day, you're doing this for positive cash flow, and then you're doing it for long-term growth. If you don't have positive cash flow coming in for 6 months or a year, you're missing out on a big part of why you're coming to this place,
Yeah, makes a lot of sense. So, I mean, just looking at it right now, I re-pulled up the spreadsheet where it shows the ROI, total monthly cash flow, it's 194. So in that 6 month to 12 month spread, you'd be losing you'd be losing $1,200 to $2,400 year one, which then affects, the positive experience from the beginning and the cash flow from day one that you would be forsaking.
Exactly.
Okay.
It's like me on the golf course, right? You hate when you're so fired up to play a round of golf. You get out there, it's like 75 degrees, it's sun shining, you're there with your friends or your family or whatnot. You're out on the golf course and you get to the first tee and you see like 10 people in front of you. It's like, hurry up and wait. Like, you're so excited to buy rental properties. You found the property that you like. Okay, let me wait 10 months to receive my first positive cash flow check. You want to find a better solution than that.
That's a great analogy, man. I thought you were gonna be like me on the golf course where you duff the first hole, but you had a more realistic thing with your skill set. All right, so I want to go back to the spreadsheet, right? So in the spreadsheet under conventional financing, we have $194 a month in monthly cash flow that's hitting your bank account day one.
Mm-hmm.
It also has the estimated conventional financing total return on investment of 10.21. We also show an appreciation rate here of 0%. And John Evans in the chat asked, I see appreciation estimated 0. So purchase for cash flow only versus your typical property that shows approximate number percentage appreciation predicted. And he's asking kind of like what to predict there. And so I guess we can just go into the usual, explain that piece.
And so this is the standard way that we share our property evaluations with all clients who are coming on board with JWB. You're going to see this property appreciation rate. Under the assumptions, it's going to say 0 right off the bat. Now, when you're speaking with my team and when we go through the client onboarding process, we're going to clearly show the different profit centers, including tax savings and principal pay down, and including home price appreciation. So this gives us the ability to do what I think you're about to do right now, which is to show the impact of home price appreciation. But one question I get very often is, why don't we include home price appreciation right off the bat? And it comes down to two things. Number one, we want to control what we can control. And the net rental income is something that we have more of a control over. When you think about home price appreciation, you can count on home price appreciation when you're invested for a full market cycle, right? So if you come to JWB, we're going to ask you to make sure that you want to own this rental property for at least 5 years. But a full market cycle is really 10 to 20 years or longer. And when you invest for a full market cycle, history tends to repeat itself with real estate appreciation. And so when you give yourself that type of a timeline, you can count on the historically accurate home price appreciation for that market. So as Pablo has put there, we see 4.3% appreciation has been added to this property on New Kings. And Pablo, what's happened to the return on investment there, buddy?
Return on investment went from 10.4 to 25.84%.
This is the real picture about why investing in rental properties is so profitable, right? We need to take off our cash flow blinders. Cash flow is incredibly important. It is the number one first thing to accomplish in owning rental properties. You must have positive cash flow because then it becomes an asset and not a liability. An asset is something that pays you positive cash flow every single month. A liability is something you pay every single month. But where most investors fail is they get there and they only focus on cash flow. In fact, they say the best property for me long-term is the best cash flow or the best cash on cash return. And that's where I deviate. The best thing to do is secure positive cash flow and then take a big picture look at all of the profit centers. And if you invest in a growth market like Jacksonville, where you get 4.3% appreciation, look at your total return on investment compared to investing in a market that doesn't grow, right? A market like Cleveland or Kansas City, right? These are low-priced markets that have not had the same type of historical growth as Jacksonville has. And so this is the real picture of all of the profit centers.
Love it, man. So I'd be remiss not to clarify. Right, let's go into it. John Aclaggy asked in the Q&A. It's kind of what you just answered, but maybe you can do it in a more succinct fashion. John Aclaggy asked, Mr. Cohen, what is the most important thing you look for when looking for rental properties? Is it price to rent ratio?
It's a great question. I mean, if I go a little bit, I'm going to say something similar to what I just said, but the first and most important thing, if you want to be passive in this type of an investment, is to find the right team. Find the right team, interview the right team. Think of this team, this property management team for you, almost like you consider the decision to have a financial advisor or a CPA, right? Those are typically teammates of yours that you put a lot of time into and you want to make sure they're the best of the best. That's the way you should interview your property manager. It's the most important thing. Once you find that team, then you can then look to the right market, okay? And then the market conversation is really kind of where I was going there. Long term, you want to be investing in markets that can achieve positive cash flow And then when they can achieve that positive cash flow, you want to do the research to see which ones have achieved the largest amount of historical home price appreciation on average. Once you do that, you want to find the best combination of positive cash flow and long-term growth. So the market is the second decision. The third part of the decision is the property and really kind of the property characteristics. That's the easiest part of the decision. If you nail number one with your team and then you nail the market, that property specific decision is the easiest part, and your team will guide you, just like we guide our clients, of course, who choose JWB and who choose Jacksonville.
That makes perfect sense. I'm gonna play in the sandbox a little bit. If someone is looking, they're going through that, right? Let's say that they are somebody that's doing it on their own, or they're thinking about passive, right? So you're doing it on your own. It's figure out who's gonna manage the property. Is it you? Is it somebody else? Is it a company? Right? Like build that out so that when you find that property that's ready to go, then you're looking, or if you're gonna go passive, you figure out, do I want somebody who's gonna, buy me a property and give it to me 6 months later, or do I want JWB, right? I'm just going to shameless plug there. To me, it's obvious that it should be JWB, but then let's take it the next step further, right? So then the market, you are looking at cash flow, combination of cash flow and historical appreciation. Therefore, I would venture to say that if you're thinking long-term, then you're going to weigh historical appreciation higher than cash flow. If you're thinking short-term, you're going to weigh cash flow slightly higher than you would if you were thinking long-term. Is that accurate?
Yeah, but let's dig a little bit deeper rather than just kind of giving that answer. The number one thing, like a home price appreciation doesn't matter to me unless you achieve positive cash flow. So like we are not investing in liabilities. We're not buying speculative homes in California, which are going to be cash flow negative, but have really high home price appreciation if you look over the last 20, 30 years, right? That's not what we're doing, because the reason that people are coming to this asset class is because they want consistent monthly passive income, right? We want to have something that pays for itself and then some every single month. So wherever your timeline is, short run or a long run, cash flow, positive cash flow is the number one most important thing. But here's a little bit of like the nuanced like deviation that is probably different than what most people hear from other people out there, is that once you achieve man, I keep screwing myself up. Once you achieve positive cash flow, you don't just continue down the path of the best property for me is the highest cash flow. Like to kind of think about John's question there, he asked about rent to price ratio, right? If you have a better rent to price ratio, you're going to achieve better positive cash flows. If you look at the rent to price ratio for a market like Cleveland versus a market like Jacksonville, you will see a better rent to price ratio in Cleveland than you will see for the same type of neighborhood demographics in Jacksonville. But why do I love Jacksonville? Why do our clients love Jacksonville knowing this? They know they could put their money in Cleveland and get slightly more each month in cash flow. It's because if we look at that long-term overall total profit center return on investment, you hold on to this thing for 10 years, you get 4.3% historical home price appreciation on an asset in Jacksonville versus 2.3% home price appreciation in Cleveland, and you win in Jacksonville, even though you didn't get as much positive cash flow. So it's like, if you're a long-term investor, you still need to pay attention to positive cash flow. That is still the first and most important thing. But then your best overall return on investment will be, once you achieve that, look at all of the profit centers, including home price appreciation, and then focus on the markets that have that historical highest amount of home price average appreciation there. Does that make sense?
Yeah. That makes sense. I didn't phrase that correctly because I was already assuming positive cash flow, right? Like positive cash flow at the end of the day, like I like to describe it because of my beliefs on quarterbacking in the NFL. It's like arm strength in quarterbacking in the NFL. You need a certain level of arm strength. After a while, it's not who's got the strongest arm. Once you have that certain level, it's the accuracy, the decision-making, everything else. But you can't show up to the NFL with my arm, no matter how smart I am.
It's like Tim Tebow, right? He had everything else. And I love Tim Tebow, right? We're going to get him on the show. It's quick plug. If anybody knows Tim Tebow, that's my ultimate goal, to get him on the show, by the way, right? Tim Tebow did not have the build, the arm strength, the mechanics to make it in the league. He had everything else off the charts, right? But he couldn't make it in the league. That's why.
Didn't have the accuracy.
With cash.
Love it. Love it. All right. Bill Shields asks, how would a deal work if using other people's money for a down payment to start a deal with JWB as far as getting the investor paid back? Or will this even work in investing with JWB?
Yeah, sure, it can work, right? So let's position this kind of like my first deal, right? When I was buying my first property, I didn't have the money. I was financeable though, right? I had a good credit score. And so it would be the same thing. I don't know Bill's situation exactly, but for anybody out there who might be in a similar situation, how could you raise the money to be able to buy that property? Well, what I did for my first property is that I went to my dad and I said, hey, Dad, can you give me a loan? And so he gave me a loan for something like $25,000. And I put the terms together with him. And I said, Dad, I'm going to pay you. I don't remember what the interest rate was, but let's call it 5% interest. And I told him that I was going to pay him back in 5 years. And so anybody could do that same thing with friend, family member, colleague, person they met at their local real estate investment club. You could partner up with somebody who has the money, but you have the financing, or maybe you have the connection to the property because you're a part of this show in this community, and that person doesn't have that connection, but they have the money, right? Maybe you have the experience and the knowledge and the insight as to how to make this thing work, and you're going to take the lead as far as communicating with JWB, and there's a value for that. And that other investor gets to be completely passive and silent in it, and they just get to get a return on investment, right? That is something you could definitely do. And so, obviously you can talk to my team about this. We would help you construct that with your friend, business friend, business partner, whatever it is. But it's a simple process. You would get the loan. You would work out the terms of the loan with that individual. That individual will make the loan to you. And then you would use that as the down payment to be able to purchase the property. And you could even purchase the property. We would be able to come up with a strategy that it would be in both investors' names at the end of the day as well. So this really is kind of the beginning of a partnership or a business venture if you wanted to make it that. So yeah, Bill, that's a great idea. It's a great, creative strategy to do. Many clients have done that. That you can even partner with IRAs as well. Many people aren't aware of this, but you can partner with a different IRA to be able to buy a property. Very similar to the way that I just described it, as far as you combine the IRAs and then they each own the property on a percentage basis, depending on how much they put into it. So those are great strategies to be able to acquire your properties.
So from that answer, it sounds like not only is it feasible, but you've seen this happen a bunch. And if you go to chatwithjwb.com, you can get on the call with the guys and they can give you a couple of examples of how you could do it. And if you decide to move forward, there is a certain amount of hand-holding and advice that Big Brother JWB is going to be able to give you, right?
Yeah, absolutely. We would want to have both of you as a part of that onboarding process, right? So if you came to JWB and said, hey, I've got my friend Bob here. Bob and I have discussed this, and we want to be able to purchase these properties together. I'm going to bring the financing. I'm going to get the loan. Bob's going to bring the down payment for the property. We want to own it together at the end of the day. Can you help us do this? And can you show me what this plan would look like over the next 1 year, 3 years, 5 years as we continue to do this? That is what our client onboarding process is built for. So we'd be able to walk you all the way through that, help you construct the property acquisition. And then of course it would be just like any other property for JWB. It would go through the contract process, the sales process, the service process, right? The property management would all be done the exact same way. So there's no difference to JWB. It's just us getting a little creative with you on the front end of the client onboarding process, which is what we love to do.
I'm going to ask you a little harder question, Greg. What's in it for that with JWB in specific, right? Like you just made a comment of like, hey, you're watching the show, you know that this property is available, you can bring it to somebody that doesn't know about it, right? But like, what's the value proposition there outside of I'm the biggest fan of the Not Your Average Investor show, right? Like what are you really offering that person? And maybe that can help John go out and have that conversation? Like what is the value prop?
Yeah, I think that there's going to be certain people that might be interested if you brought them this opportunity, and there's certainly going to be a lot of people that aren't, right? If everybody had $1 for every real estate guy out there who said, "Oh, I got a great deal for you. You should invest in this," right? I mean, we've all seen those late night infomercials, right? I think what you have to identify is, number one, people that have built-in trust with you, right? You're not going to earn trust by bringing them a deal. The trust needs to be there. They need to be in your corner. They also should have, over time, because you know this individual well, they should have expressed some interest in real estate investing and in your success, right? So if you already have built-in trust, and in conversations and time that you spent with this individual, they have shown that they're interested in real estate investing and they're interested in you and being successful, that's a huge plus. You need to have that. I would say the third thing, if you're trying to identify people who might be a good fit to kind of partner up with in this kind of way, would be if you've heard people complaining about how their investments are doing elsewhere, meaning in the stock market. They are not happy with the volatility of the stock market. They're not happy with how their 401k is performing. They're not happy that they have so much money on a percentage basis in the stock market, and they're fearful that may take a nosedive at any point in time, and they're fearful of that. So if you've heard any of those buzzwords, that's a really good person to approach and say, here's how I think this could be a win for all of us, right? The way I used to do it, and this was really successful with friends and family and close relationships that I had, is I position this as a team sport. Right? I said, okay, here's how I'd like to do this. I think that this would be an amazing opportunity for me, but I think it's going to be an amazing opportunity for you. And I'm familiar with this, but let me show you the way. Let me guide you onto doing this, kind of get your feet wet, where you know that I'm fully committed, that my money's in the game, or my financing is on the line. And that, of course, helps people feel better that you're not selling them on something. You're really providing an opportunity. But focus with number one and number two, making sure that these people have trust with you and that they have, at least at some point, expressed some interest in real estate investing.
That makes sense. All right. We're going to go real quick, rapid fire. John Aklagi asks, Mr. Cohen, when forming one of these partnerships, how much should each person receive percentage-wise? Should it be 50-50, or is that kind of one of these like chat with JWB and we'll figure out how to massage it?
Yeah, I should chat with my team about it. We can give you some insight. The reality is that it could be whatever you and your partner decide is fair. I mean, typically the amount, there needs to be value for both. So 50-50 is always the easiest for partners, but it's not always right. If somebody put a lot more into the deal in terms of value or financing ability or experience or management of it, you could do 75-25, you can do 51-49, all things are possible.
Okay, and I was about to say last question, and then two popped in here, Greg. I know that we're going to try to get off at 1:15. Are you cool with another 5 minutes?
Let's roll.
All right, let's roll. Marilyn Cotterman asks, would you recommend owning a rental home in your personal name or confidentially in an LLC? And can an LLC get a loan at the same rate as a personal name?
Okay. So I'll tell you my personal experience. When my business partners and I started to acquire rental properties back in 2006 and 2007, we acquired about 40 rental properties in the first year and a half, bought them all in our personal names. Totally aware that if you put them in a trust or if you put them in an LLC, there's certain anonymity and then asset protection is better when you're in an LLC. But why did I put them in my personal name? Well, number one, financing. You cannot get conventional financing if you're putting it into an LLC or to a company. Banks won't do that. They want and they require that it's in your personal name. So that's why we did that. Then there are strategies that you can then transfer it to an LLC. My team can walk you through this. It's a little bit complicated, but we would help you with it. But I didn't make the decision to do that for a long time. Really. And I had about 40 rental properties at this point, and we still didn't do it. And the reason that I didn't was because it's just a hassle. It's a hassle. Whenever you create an LLC, you have to keep meeting minutes. You have to have separate bank accounts. It became a big hassle. And the other thing for me is that asset protection can be accomplished in a number of different ways, right? For me, insurance is your first form of asset protection, right? So we work with a great insurance team, the Ritchie Insurance Group, which all of our clients work with and you would be introduced to. And we went to Whitney and her team and said, we want to be insured to a point where we don't have to worry about somebody suing us and then us losing money because of some frivolous lawsuit. And so we insured ourselves to that level, and that helped me sleep well at night. So it was a combination of those things. Now, we have other clients that start right off the bat and will go straight to an LLC. So I can't tell you what is right for you. I'm a little bit more, I'm okay with the idea that it's in my personal name and insurance. There is more asset protection if you go into an LLC, right? There's also more hassles, there's more costs, annual fees, and things like that. But if you are somebody who wants to make sure that you have assets protected in an LLC, you can do it. It's just going to require a little bit of extra kind of a complicated structure, and we would help you do it. We certainly can. And then the financing thing is something we would also have to help you accomplish. It's a little bit of a complicated structure as to how you would be able to eventually end up in an LLC, but you would have to close on the property in your personal name either way if you want to get conventional financing.
All right. That made a lot of sense there. Okay, real quick. Zach Correa asks, actually, he says something real quick and then asks something. Success criteria to partner with JWB. Great property management team, residents in place with 2+ year lease, immediate income, bread and butter JWB properties, and the Jacksonville market is expected to have some higher potential appreciation. So great opportunities for future growth. Win-win. Thank you, Zach. I totally agree. I think you agree too, Greg.
100%. Zach nailed it. I think he should replace me. I don't even think I need to be here anymore. Zach nailed it right there. In fact, Zach would be an amazing guest to get on the show. I know him and his family are big investors of ours, and we certainly appreciate their trust, and would be an awesome learning experience for all of us. So maybe we'll get Zach up here sometime soon.
There you go, Zach. You just got yourself a spot on the Not Your Average Investor show. He also asks, what percentage of JWB's portfolio is new construction versus rehab?
So, and I looked up the business plan from 2020. I did this in a walk and talk not too long ago, which I do every day in the group. So out of the 680 houses that we plan to buy in 2020, which is exactly what we're on pace for, 72% of those were brand new construction lots. So 28% were renovations. If you look at our portfolio of the homes that we're selling on a weekly basis, and of course it changes from here and there, roughly 75% of the homes that we have are new construction, right? So the reason, and I don't want people to think that we love new construction more than renovations, right? That would be an easy argument to make, but the reality is we love both. The reason why we are stronger and heavier in new construction lots than renovations kind of goes back to that inventory conversation we had in the beginning here, right? The reason why most providers out there are struggling with inventory is because they can only buy renovations. There's such a shortage of inventory out there that if JWB only had to rely on buying renovated homes or buying homes to then renovate, we just simply would not be able to meet our demand for the number of homes that we're selling, right? 28% of 680 is less than the number of homes we're going to sell this year. So it's just a function of the marketplace. There's such a shortage of inventory. We realized this many, many years ago. We've been buying a lot of lots and stockpiling them, and we're continuing to do that right now. And we do that so that we can create our own inventory. So Zach, you won't come to us and say, hey, I want to buy another 3, 5, 10 houses. And we're not going to say, you know what, Zach, sorry, we don't have the inventory. We're not going to put you on a waiting list like other inventory providers do.
You know, Greg, we didn't hit on something that's kind of unique to this property that we've been showcasing here on New Kings Lane. And it's that this wasn't a new construction. It also wasn't recently renovated, right? This is something that JWB had owned in their own portfolio that you made available. You want to kind of tell us a little bit about that?
Yeah, just another great example of kind of how we have to think ahead. We have to have excess inventory in order to be able for me to come on the show and say, hey, you're not going to sell us out, right? We're not going to put you on a waiting list. Well, sometimes we have surges of sales. and it's always wonderful. But the best thing about our business is that when you have a surge of sales, right, that means that another part of the pipeline, you got to put some more attention somewhere else, right? So we've sold about 75 homes in the last 3 weeks, which is more than normal for us. So thank you to all the clients out there for putting your trust in us. It's a really fun time. Now, when that happens, we might not have 25 new homes that are hitting the market each of those weeks, right? So that can create a temporary inventory crunch. Well, what does JWB do? Well, we have a number of ways to be able to make sure that we have inventory for clients. So this house on New Kings was in our inventory, something that we bought. And just yesterday, I'm sitting with my business partners and we're saying, wow, 75 sales, that's a lot. Do we have enough inventory to meet demand for the next 6 weeks? Let's make sure that we do with our normal inventory that we're buying and renovating. And so what we did is, instead of taking this property on New Kings Road and we were going to put it into our own portfolio, we were going to refinance it, incur some costs, and then put it into our own portfolio. We said, let's sell that one. Let's make it available for clients to make sure that we don't have any shortage of inventory. So we do this every single week. That's really kind of the secret sauce, is we have excess buckets of inventory, either from renovated homes, new construction lots. We can fire those up and start to build those many months in advance. So we're kind of playing this complicated game of chess every single week when it comes to inventory, to make sure that we separate ourselves from every other inventory provider out there, so that Zach can come to us, so that Lee can come to us and say, okay, I'm ready to continue that buying plan that I have. What's the great investment for me to purchase today? So that's how this New Kings Road property came to be.
If I'm hearing this correctly, Greg, like you've said multiple times that you and your partners individually own 300 or so rental properties in Jacksonville. Was this one of those properties that you just said, all right, we're just going to offer it to a client?
Yeah. We have between 300 to 400 properties that are actually company owned that we do not intend to sell, right? But what that does, and I tell people we own over 300 because I know there's more than 300. It gives me a little bit of room to say, you know what? In a surge where we have 75 sales in the last 3 weeks, we want to make sure that inventory is not going to be crunched at whatever point. Gives us some latitude. And we can go into that reserve of things that we, of course, believe in, that are already rented, that we can then sell because they're the same neighborhoods, the same assets that we would sell to our clients. So it's another part of kind of reserves inventory for us that we can make available if need be. And that's really where New Kings came from.
Awesome, man. Arthur Haber here in the chat asks a good question that I know you like to answer. Does the ROI work better on new construction versus renovated homes?
Great question. The answer is not necessarily, and probably no. If you've been listening to the property of the week, the last few weeks, we've had some return on investment properties that are close to 11%, which is really the top of the line that you're going to see here in Jacksonville. And those have been renovations. Right. We've also shown some new construction properties that have been, 10.25% returns, which is certainly nothing to sneeze at. It's just a great return. We've shown some new construction that's 11% returns, right? So what you're going to find is that renovations and new construction can easily be between 9 to 11%. One is not going to have a better return on investment than another. With new construction, you generally have a higher purchase price, which lowers your return on investment, but you get a little bit more rent for it as well. So that kind of balances that out, right? You generally have higher property taxes because your purchase price is a little bit higher, but you have lower property insurance costs as well. So it kind of balances it out. And then your maintenance costs are a little bit lower on new construction than renovations. So conversely, right, renovations, lower purchase price, just like we see on New Kings, all right? The rents are still strong, right? So that of course gets you a higher return on investment. Your property taxes are typically a little bit lower than they would be for a new construction home. Insurance costs are a little bit higher. And then your maintenance costs are going to be slightly higher as well. All of that comes together and you're going to see, whether new construction or renovation, you're going to see between 9 to 11%. And that's why I started out saying I love new construction, I love renovations. They're both excellent. It's just, how do you get to that 9 to 11% return?
Yeah, and Arthur, you're asking some pretty concrete questions. I would encourage you to either go to that jwbwebclass.com and get the investors toolkit so you can see all these numbers, or even go to chatwithjwb.com and and schedule a call. It sounds like you've got some stuff in your head that might require a personal answer. So I would encourage you to go that way. Gregg, man, I want to let you off, but I got to ask you, what do you think is, 75 sales in a week sounds like a ton. Like what's driving so much demand?
Well, it's 75 in the last 3 weeks. So
still a ton, 25 houses a week. Sounds like a ton.
I think it's a few things, right? I think low interest rates are just sinking in. I mean, I read an article every single day, and the interest rates are reaching all-time lows every single day. So I think that continues to really create this opportunity for folks out there. I mean, what I keep kind of just singing from the rooftops is that I think this is the greatest opportunity to create generational wealth right now in rental properties because of the debt. It's so inexpensive. And when you acquire debt at an interest rate of 4% and it's in place for 30 years, I mean, you're not going to see that again anytime in the future, but it's fixed. It's there for you. So, I mean, and other people are seeing it. Mortgage applications are flying off the charts. I'm reading articles about here how banks say they can't keep up with demand and it's only going to get more and more over the next 6 months. They're hiring, I read one article, a bank's hiring 2,000 more people, right, to be able to service. So I think that's a big part of it. Quite honestly, Pablo, I think our group and our show and the community that we've built has really helped. We get, 100 people each week that are kind of listening and we get the opportunity to kind of help, teach, train, and it's great when people have been tuning in now for 3 months, 6 months, a year now, and they kind of heard our message. So, a lot of our folks, a lot of our community are taking those steps. So thank you to all of you who are doing that. But we're excited. I think it's about the complete experience, and, a lot of our purchases have been repeat purchases as well. So that's the greatest testament to how good of a job we're doing. So it's a fun time.
Sounds good, man. I love that. I love that it's partly attributed to this group, right? Because I love everybody that hangs out here, right? Like we have these regular friends of ours that we get to spend Tuesday and Thursday with. I'm so grateful for, Lee and Marilyn and Medj and Mike and John and Leo and, like everybody that we see, Bill, everybody that we see here week after week. And to think that that's also helping people plan for their retirement, get financial independence, all that stuff, man. It's so incredibly rewarding. And to go back to one of Marilyn's questions about the LLC, little teaser for next week, right? We got Al Nicoletti coming on the show. He's a probate attorney, right? His specialty is making sure that you get to hand down your property, your investments to the next generation. So Marilyn, I think you're going to like that show, and you're going to get to ask him some interesting questions of the stories of things that he's seen of what may slow that down, or what may create the opportunity for somebody else to come in and take this from, the people that you are building this nest egg for, apart from yourself, that goes on after you, which I know is one of Lee's strategies as well, and one of yours as well, right? Like you are teaching your kids the value of investing and all this stuff via what you're doing. So I think it's going to be a really, really valuable show on Tuesday. Al Nicoletti, awesome guy, local here in Jacksonville, has these big sleepy puppy dog eyes, really friendly. and I think people are going to like it. Apart from that, I encourage you all to go to jwbwebclass.com if you haven't done it already. Catch the webinar before Gregg changes it to a new webinar. Get the investor toolkit so you can mess around with it. And thank you so much for being here on a Thursday. And Gregg, buddy, I'm gonna leave it up for you to take us away here.
Like always, I think you nailed it, brother. Thank you again to everybody for being on the show. They get more and more fun every Thursday, and really looking forward to Tuesday's show. I know a lot of you have questions in your mind. You maybe have chatted with my team and have said, hey, I really want to build a plan for the next 1 year, 3 years, 5 years, but you also want to build a plan for the next generation. Well, that's what this call is about. Talk to somebody who is going to absolutely help you build that plan, structure this to make sure that this isn't just a positive cash flow and appreciation thing for you, but it's a way for you to create generational wealth. So we're super excited about it. We'll catch you on Tuesday.
All right. See you all on Tuesday. I'm just going to say a last thank you, Medj. Thank you. Everybody that's been typing, great show. Thank you all. Thank you all. Really, really appreciate you. And welcome podcast listener that is on for the first time listening to the JWB Property of the Week.
Week.